Welcome back, everyone. We are in the part 5 of our amendment series discussion, and in today's session, I'm going to discuss the amendments that has happened in input tax credit chapter. So, comparing to the all amendments that I have discussed till now, this particular chapter amendment happens to be the most important one for November examination. So, there are 4 amendments that has happened in this particular chapter. Out of that, 3 amendments are applicable for both final as well as intermediate students. So the last amendments intermediate students can skip, but then make sure that you attend the entire video, unlike your earlier videos where if you have thought of skipping, do not skip it. Let us go through the entire set of amendments in ITC, because 99.99% there's a chance that one of these are there in your November examination that you're going to write. Okay, so I hope you're ready. Let's go through what are the 4 amendments that we have to get you an idea on what is this amendment all about, and then we will go ahead with details. First one is only 10% of ITC available for invoices debit note that are not uploaded in GST 1. So there was this provision earlier, and this provision was saying that 20% of ITC will be available for those invoices not reflected in GSTR 1 uploaded by the supplier, for the recipient, registered recipient, to take ITC. Now that percentage has been reduced to 10% from January 2020, and that's made applicable for November examination. Now, power is given to the commissioner for imposing restrictions on availment of ITC on your electronic credit ledger. So they can come up and say that, okay, whatever is there on electronic credit ledger, I will not let you take this much of ITC because you have done something. We will see what are the things on which they can restrict your ITC. Then amendment in rule 43, which is an important amendment, wherein we have a methodology in which we will apportion the ITC on capital goods which are used for business, non-business, taxable, exempted, all of this. We call it as common credit. So common credit apportionment has slight changes, not very much. There has been, when you read the statutory update by ICI, the clarity that you might get on this apportionment of ITC and capital goods might be a little less, but then yes, they do have examples. We will also try to take up example and then try to understand it. Then, clarification in apportionment of ITC in case of reorganization of business under section 18.3 read with rule 41. So there is again clarification what happens when reorganization is there and there is a transfer that happens out of demerger or similar cases. A part of your business and part of your electronic credit ledger ITC has been transferred to the new entity. And what are the things that you have to be careful when you're filing ITC-02, which is a form we use for transferring the ITC to the new entity. So this particular last amendment alone is applicable only for final, though the portion is applicable for intermediate. This amendment clarification is not part of your statutory update, which means that they're not going to ask you a detailed question on this. So do not bother your time on understanding the 4th one, but the first 3, all of you, it's very important. Let's get started. Okay, so let's look at the notes. We will first go through the notes and then have understanding. Then we will go ahead and then put some examples as well. Okay, so when if you had downloaded the first version of the notes, I would recommend you to go ahead and then download it once again. Reason being, there was some mistake in this particular portion. I did not update it fully. So if you have the earlier notes, how do you check whether it's the earlier note? You'll have to see whether notification 49 2019 is already there or notification 75 is also mentioned on the top. If it is, then yes, it is updated. If not, your percentage would have been 20%. That is updated. That's the amendment that I'm going to discuss. So rule 36 sub rule 4 has been amended, and they said where an invoice, so which talks about condition for availing ITC. We already know that there are few conditions for taking ITC, and this particular condition has been updated. Okay, so what is this update on the condition? See, we already know that there are 4 conditions, 16 subsection 2 clauses, A, B, C, D, wherein you will have to satisfied, then only you can take the credit. Like you should have the invoices, you should receive the product, the tax should be paid, you should file GST or 3B, and all these things has to be satisfied. Apart from that, if you have an invoice, I made a purchase, which we call in GST as inward supply. I made an inward supply, it could be goods or it could be services. Now I have the invoices, I have paid GST, can I take the credit? You can take the credit only when you satisfy this, or you can take the credit only by using this particular provision. What is that provision that we are discussing here? So, what an invoice, we can have two scenarios. Say, an invoice is or debit note has been uploaded by the supplier in his GSTR1, then amount of ITC to be claimed by recipient is full ITC if all other conditions are satisfied. Where invoices or debit note has not been uploaded by the supplier in his GSTR1, 10% of eligible ITC available can be claimed, or actual ITC, whichever is lower. I know that this provision might go a little above your head unless you know what is GSTR1 and what is this claiming of ITC all about. So I'm going to just quickly give you an understanding on the return structure so that you can make understanding of this entire provision. So every registered person, including casual taxable person, they all have to file a return called as GSTR1. What is this return? This is a return on outward supply. When will you file it? Next month before 10th. Say if it's January, then I'll file this particular return before 10th of February. If it's February, 10th of March, and so on. This is how it will go. I'll file the next month 10th before that, which means that I can file from 1st of that month to 10th of that month. Any time I can file without paying a late fee. Now, when I file this, I will have to mention invoice number, recipient GSTN. I'll give you a few details. Taxable amount, CGST, SGST, or IGST. All these details will be uploaded. So these details will be given. So if it's a business to business transaction, which means that a registered person making supply to another registered person, they will have to give invoice wise details. Okay, this is the first set of information that you should know. So every registered person, including CTP, there are certain people who are not making a taxable supply, like a TDS person, a TCS person, or an input service distributor, and there are specific exclusion that is given for OIDAR, and this is separate return that is available for an RTP. So except these people, all others will have to, all other registered person and casual taxable person will have to submit GST1 on or before 10th of subsequent month. But then there is one additional relaxation that is coming, which said if your previous financial year turnover happened to be less than or equal to 1.5 crores, what's the relaxation that is available to you? You need not file it on monthly basis, you can go for quarterly filing. So which means that Jan, Feb, March, all these invoices together you can upload in the next month, which means that I need not submit on January my invoices, February my invoices, March. I'll consolidate this and then upload it in one GSTR1. You guys with me on this? Okay, so this provision is there. So what happens is, I'm going to give you a number. Suppose this is Show Me Wholesaler, and they're making supply to MyG Mobiles. If that's the case, then say for example invoice number 1001, value happened to be 1 lakh, say it's IGST 18,000. This happened to be in January 2020. Now these are the supplier, both of them are registered. MyG is the recipient. MyG is a mobile phone dealer. Now Xiaomi will have to file GSTR1 the subsequent month. Okay, February 10th. So this is a B2B transaction. So this information will be uploaded. Now MyG wants to take input tax credit now. What are the conditions to be satisfied? Section 16 subsection 2 clause A, B, C, D says that there are 4 conditions to be satisfied. Now MyG satisfy all the 4 conditions. Can they take the credit? The answer is no. They can take the credit only when this information, this invoice is uploaded by Xiaomi wholesaler in their GSTR1. Once it is uploaded, then only MyG can take the credit. Now the government is saying that, see, it is not enough that you made a purchase. You ensure that he gives that particular details. I don't want any fake invoices to be there. I want to ensure that these details are being uploaded by them so that I can track it. So okay, there is no mismatch of numbers that you have. Otherwise, what's the problem? Say Xiaomi says that I have made a supply for 1 lakh rupees and GST payable by me is 18,000. Now MyG says that no, I purchased for 2 lakh and GST credit I have is 36,000. How do I cross check? So government says, see, there is so much of data that is possible at this particular point. We are living in the era of technology, so let them upload the correct information. Let MyG get this particular information and then take the credit. It has to be same. The supply of a person will be the inward supply of another person, and for somebody who is paying taxes, that only I can give it as credit. Now government needs a mechanism to check this, to ensure that section 16.2 is completely implemented. So they're saying that, see, Xiaomi has to upload this information for MyG to take the credit. Now, how will MyG know that they have uploaded this information? It will be made available like an incoming message. Okay, when we open Facebook, there are a lot of incoming messages coming. Likewise, there is an incoming that will be coming to the GST number in GST portal of MyG in a automated generated return called as GSTR2 automated, GSTR2A. This particular amount will be made available there. So whatever is made available in GSTR2A, that's all you can take the credit. Now I made, say for example, MyG has for that particular month 100 invoices with them. Physically they have 100 invoices, and out of that they have 10 lakh rupees of GST on that. Okay, so in January, in total, MyG has 100 invoices with them, plus they have, in this 100 invoices, if you add all the GST credit should be available, should be 10 lakh. Question number 1, can they take the credit of all these 100 invoices? The answer is no. They can take the credit of this 100 invoices only when this 100 invoices are uploaded by their supplier in their GSTR1 and made available to this MyG in their GSTR2A. Then only they can take the credit. Now there are 2 reasons why it will not come in their GSTR2A. Reason 1 is a legitimate reason. Reason 2 is not a legitimate reason. Reason 2, which is not a legitimate reason, is what I'm going to tell you now. First, that my supplier did not pay taxes. My supplier did not update the details. So government is saying that, why should I give you the credit? You call your supplier, don't transact with them. He's not a compliant person. Don't do business with him. How will I encouraging you doing business? I will not give you the credit unless he uploads the information. Are you understanding this? Okay, so what is the first legitimate reason? See, in the January month, my supplier might not upload the details if my supplier's turnover is less than 1.5 crores and they're opted for quarterly filing of GSTR1. I told you that there's an option to file it on quarterly basis if the turnover is less. So if they have decided they'll upload the details only on quarterly basis, the January invoices will be uploaded by them only in April, not in the month of February. Now I want to take the credit in February. It is not there in my GSTR 2A because my supplier, he's legitimately has opted for, government only gave him the option. He has opted for quarterly filing, though, so it will not come in this month. It will come later. Now, can the government tell me that, okay, because they have opted for the available option of government legitimately, now can the government tell me that I'll not give you the credit? No. So the government assumes that about 10% of people could be opting for that. The totally, the turnover, if you take the number of invoices you take, maybe 10% of people could be supplying to another businesses and they might not be registered. So in such cases, I will give you additional 10% credit. It says that there could be, I'm going to give case 1. Case 1. Out of this, 50 invoices are available in GSTR 1. Out of that, you have a GST of 9.5 crores. Can I take full ITC? Yes. There is another 50 invoices. It is uploaded, not uploaded, not uploaded. But still, there could be some of them who are opted for quarterly filing. So government says, it's not like I don't give you any credit. I'll give you 10% of eligible credit, additional. Probably that many people could be opting for this quarterly filing. So you will get another 10%, which is 0.95. So your total is 10.45. Now should I give you, 10.45 lakhs. So should I be giving you more credit than what is 10 lakh? No. So it is restricted to 10 lakh. So now you can take full credit in this particular case. Suppose they have 30 invoices available in GSTR 1, which is having a GST of 6 lakh. For the balance 70 invoices, you can take only 10% additional, which is 0.6 lakh. So your credit would be 6.6 lakh. Balance credit you cannot avail in this month. You will have to wait for it to be reflected in your GSTR 2A for you to take the credit. So this is the provision that we have. Now we can go back and then have a read at it. So were the invoices or debit note of the other person uploaded in their GSTR 1, it is available to me to view in my GSTR 2A, then you can take the full credit of such invoices and debit note. Whatever is not uploaded, you will be eligible to take 10% of eligible ITC available, but you have to see, is it crossing my total ITC that is available on all my invoices? So actual ITC, whichever is lower, is what you can take. So how this is going to be reflected in our examination question? They can give you, after you compute ITC in your, if you remember, we have a structure in which we will compute net GST payable. In that second part, it is input tax credit. Computation of input tax credit eligible. So when you get a total of input tax credit eligible, they might give you another additional information saying that, see, out of this particular ITC, only 50 invoices are reflected in GSTR 1 and the credit happened to be this. So they should add one more 10% and then give the credit only to that extent. Are you guys understanding this? Okay. So this is the provision. Otherwise also they can give you a small question where they can test you this with. The example is something that I've already discussed. Let us go to the second discussion. I'm going to discuss where you don't get the ITC. Then I'll come back to the apportionment. Okay. So there's a new rule, 86A, where power has been given to the commissioner or officer, which is assistant commissioner and above, to impose restriction on ITC if he has reason to believe that ITC fraudulently availed or it is ineligible, and he can impose restriction for a period up to 1 year, and if it is shown sufficient causes, he can relax it. Okay, but there is a power that is given to impose restriction on ITC. What are the circumstances in which they will impose restriction on ITC on your electronic credit ledger? It will be reason number 1. invoice or document on which ITC has been availed is issued by a non-existent supplier or person not doing business from a registered place. All the fraudulent cases, you have taken ITC without actually having a supplier, or which is having a supplier and you've got the supply from a place other than the registered place. Then second one, you did not receive the goods and you still took ITC, or the tax has not been paid to the government by him. In such cases, they can actually impose restriction on your ITC availment. Then person availing ITC, non-existent or not doing business from registered place. This is the person who's taking ITC. The recipient itself is not existing. There is someone who is actually chumma, he's filing the returns and then trying to take ITC, but there's no real business that he's doing. He's non-existent, or he's doing business from a place which is not informed to the government. Then person availing ITC is not in the possession of an invoice. In all these cases, we already know that these conditions are already there in the case of our section 16, where you have to satisfy for taking ITC. So if these conditions are not satisfied, then they can impose a restriction. Commissioner or an officer who is at the rank of more than assistant commissioner and above, they can actually come and impose a restriction on your availment of ITC for a 1 year period. Okay, this is an additional provision we have. Now let us go to the giant in the room, which is our discussion on Rule 43. Okay, I'm going to make you read this once so that you become familiar with the words that I'm going to recite after this. Rule 43 talks about methodology of apportionment of credit of capital goods. So it's a 3-step process in which we will apportion the credit, and there's a slight change. There's been few aspect of it is removed, and then there is few additional portions that have been added. See, we have 2 rules for apportionment of ITC. Why should we apportion the ITC? Because if I am exclusively using my input services and capital goods for taxable supply, including zero rated supply, there's no problem. I can take full ITC. Or if I'm making an inward supply, and if I made an inward supply and I've exclusively used it for non-taxable supply or exempt supply or non-business purpose, I can say fully I don't give you the credit. What if I have made a common supply which I have used for my multiple product? I can have multiple products, right? So I've applied it. Say for example, I made a common purchase of milk, or I've made common purchase of milk powder, or I've made common purchase of chocolate, and then I've used it for my toffee, which is taxable, and I've used it for something that is exempted. So I can have multiple products wherein I will have inward supply which is common. Now will I be allowed to take the full credit there, or will I be asked to take the credit to the extent which is eligible? So the government says, when you have 2 outward supplies, one is taxable, exempted, or you're making a common purchase and you're using it for both, I cannot say that I'll not give you any credit, or at the same time I cannot say that I'll give you full credit. So I will ask you to take the credit which we call as common credit and reverse the credit which is ineligible, add it to output tax liability. This is how the provision generally runs on. So in this particular understanding, okay, this is very basic understanding. I want you to think and then approach this particular provision. So if I am having an outward supply which is taxable and exempted, or I made an inward supply and which I have used for personal purpose as well as business purpose, business and non-business, in such case also I have to apportion. Now there are 2 rules in which we will do the apportionment. The basis is turnover only. So the understanding is very clear and it's simple. Now what will I do is that, if I have made a purchase and I have paid GST of 1 lakh and I have 50% of my outward supply taxable, 50% not taxable, I will reverse up to 50% of this credit. I'll add it to the output tax liability and take 1 lakh rupees as credit, reverse 50,000. So in net I'm getting 50,000 credit only. That's a very easy understanding. So this is how I'm going to do it in case of inputs and input services, which is dealt in Rule 42. In Rule 43, there's a separate provision or a slight change in provision which is proposed for capital goods. We will try to understand that. We will try to first read it through. So I have given you a structure in which where I'm giving what is the type of capital goods and what's the name that we're going to call it in this particular rule 43, and how much amount will be credited to electronic credit ledger and how much will be part of common credit. First set of capital goods are capital goods which are capitalized in the books of accounts, like machinery. So I've purchased a machinery. Input tax on that capital goods, which is machinery, which is used or intended to be used exclusively for making exempt supply or non-business purpose. So I have made an inward supply which I am exclusively using for exempt supply or non-business purpose. So I can directly say that you're using it for exempt or non-business, you won't get the credit. So the amount credited to electronic credit ledger would be nothing. You don't get any credit. Nothing I'll do as a part of common credit and apportionment. Then second type of capital goods is that I have input tax on capital goods which are used or intended to be used exclusively for taxable supply, including zero rated supply. This is fully used for taxable and zero rated, which is fully eligible for credit. So there's no problem there that I will tell you that I won't give you credit. So you will get full credit. There's nothing that I have to apportion, so nothing will be part of common credit. Then balance, whatever is left out, could be what? Could be used for business, non-business, and exempted, all of this. So these things are called as an ITC on or input tax paid on these things are called as capital A. So we will add all such assets and we will call it as TC. And there's an additional provision and that much amount will be credited to electronic credit ledger, and this will be called as a part of my common credit. Now what I should do is, after that, step 2. So there's no amendment in any of these provisions. Okay, this is all common. Amendment is in something else. So I will compute my common credit for a tax period by dividing this with the 60 months. So they're saying that distribute this credit over 60 months. Why we are doing it, I'll tell you that. Then you have to apply for each month for that 60 months time period from the date of invoice of this capital goods, and you have to reverse the credit to the proportion of exempted supply. So E divided by F. E is exempt supply. In section 17.3 it's been defined, and F is called as total turnover. So you have to do this reversal for 60 months, and that particular amount will be added to the output tax liability. This is the provision. Now what is the amendment that we have? Amendments are on this. There is a conversion that could happen, which means earlier if there is an capital goods used exclusively for making taxable supply gets subsequently covered in common credit, which means that it started being used for both taxable as well as exempted, then the amount credited to electronic credit ledger would be nothing, but then full amount will be treated as part of common credit, which was earlier different. They used to reduce 5% and then make it part of common credit. Now full amount will be part of common credit. Then earlier, which is used for exclusively non-business or exempt supply, gets subsequently covered as common credit. The amount credited to electronic credit ledger will be the total amount again. That will be considered to be part of A. Then I'll give full amount credited to electronic credit ledger as well as full amount will be part of common credit. But there is a portion which I'll have to call it as ineligible credit and add back, which is called as TIE. So there's a new term they have introduced. Okay, so this is the case of exempt supply being subsequently covered as exempt and taxable. In such cases, you have to reverse the credit and then give full amount as electronic credit ledger, then do the apportionment for 60 months, and this is a little confusing for you. So let me start putting numbers to it and give you understanding of it. Okay. Carefully follow, you will understand this. Say VKC is manufacturing two products, product A, product B. Suppose product A is exempted, product B is taxable. Their turnover is 10 lakh and 10 lakh each. Which means that their ratio happened to be 50-50. They have made following purchases. They purchased machine X, machine Y, machine said. GST paid on all of this happened to be same 10,000 rupees. The use of X was only for A, this was only for B, and this was used for both. Now, whether this amount will be credited to electronic credit ledger and whether this amount is part of common credit, we'll try to determine. Machine X is used only for A. A is exempted, so nothing will be credited to electronic credit ledger, nothing will be part of common credit. Y is only used for B, which is fully taxable, so 10,000 will be credited to electronic credit ledger, nothing will be part of common credit because I have to give them full credit. But wherein B is used for both, which is both A and B exempted and taxable, thereby you have to give full credit to electronic credit ledger and 10,000 will be treated as common credit. So totally you have 20,000 will be credited to electronic credit ledger, 10,000 will be common credit, which I requires some apportionment. If this was input or input service, then I would have taken what is the turnover of that particular month and then I would have apportioned. This is for the month of Jan 2020. Okay, so January 2020, this is the turnover that we have. So what we would have done is that we would take that monthly turnover and then apportion. No problem at all. Now the problem here is, now what's the logic of doing this? They're saying that when you are purchasing inputs, you will be using it on your process and your output would reflect what is the percentage of that input you have used for both, isn't it? So they're saying that in this particular month you're producing, if you have a common purchase and you're producing 50% of exempted, 50% of taxable, which means that your credit has to be apportioned in that ratio. But this can be true only for input or input services because capital goods usage is not for a month. In GST, we are assuming capital goods will be used for 5 years. We have already seen this particular provision in 18.6 read with Rule 40. There we are assuming it to be for 5 years that's a common assumption that we have in GST, where we say that the time period of an time period that we have for an asset is considered to be 5 years. So in this particular 5 years period of time, you will have each month turnover will be reflecting this particular ITC or this particular machine's product. Okay, so that machine is being used for outward supply. We are assuming that will be used for at least 5 years of time. So each 5-year turnover will reflect how much will be the percentage of exempted to the total turnover. So they're saying don't do the reversal in this month. Spread it out for 5 years, which means that this 10,000 will be divided with 60 months. Which is 167 rupees each month will be your common credit, which this will be called as TM. This is called as TC. Now what we should do is that we have to spread this particular 60 months, 167 into 50%. Suppose it is 83.5. So every month for the next 60 months, I will start reversing 83.5. Not exactly 83.5 because this 50% ratio is for this month. Next month, if it is 40%, it will be reversing 167 into 40%. Has to be reversed. Likewise, I have to reverse it for 60 months. So in total, the entire portion of exempted will get reversed. This is the provision that we have. Are you guys following how this is being done? Okay, so as and when you have an inward supply, which is capital goods, and it is used for, if it is used for both taxable as well as exempted, or business as well as non-business, then you will have to do the reversal like this. What you have to understand here is, instead of just one machine, you can have multiple machine that is being purchased. So each of this machine, you will add it to the common credit. Common credit will be the total of all such machines which are used for both taxable as well as exempted. Now, what is the amendment? What's the change that we have here? I'll tell you the change. Say, 1st of January 2019. Today is 1st January 2020. 1st January 2019, there was a machine I had purchased called as machine P. At that time, I had used it only for taxable, and GST was 60,000. You tell me what would have been the treatment at that particular point in time. This is fully used for taxable. So how much will be credited to electronic credit ledger? Full 60,000. I'll give you the credit. Is something part of common credit? Nothing. Because it's fully used for taxable, I'm eligible for full credit. But on 1st of January 2020, you converted this machine, or this particular machine P started being used for both taxable and exempted. In such cases, now onwards, what is the total lifetime of this machine? Is 60 months. This is how much period? 12 months. This is how much period? 48 months. So ideally, for the next 48 months, are you eligible for full credit? No. But you've already taken full credit here. It's been utilized also. So, but effectively, logically, you're not eligible for full credit there. So, the provision says that now from 1st January 2020 onwards till, okay, which is 31st December 24. Till that date, you will have to start reversing. Should I reverse full? No, I don't need to reverse full. I have to reverse a portion of it because I could be using it for both exempted and taxable. I should reverse a portion in that particular ratio for next 48 months. So what will I do is that now I will I give any credit to the electronic credit ledger now? Nothing, because it's been fully credited. But how much will I treat it to be part of common credit? Full 60,000. This is the amendment. Earlier, we used to reduce 5% and then make that as a part of, for every quarter we used to reduce 5% and that as a part of common credit. They said, no, if you do that, you're getting another 5 years of period of time from this 1st of January. That's not there. I'm going to give you from the invoice date. From the invoice date, I'm going to give you 60 months time. That is the lifetime of a capital goods. And in that cases, from the time you are converting till the from invoice date 60 months is expiring, for the balance 48 months, you will have to reverse 1 divided by 60, that is 1000 rupees into E divided by F. This has to be reversed for next 48 months. So effectively what happens? This 12 months period of time, you would have got 100% of the credit. Then balance period of time, I've given you full credit already in the 1st of January 2019 itself. For the next 48 months, 1000 into E divided by F, a portion will start getting reversed. That will amount to how much that is being used for the next 48 months for exempted. This is the first case, that is the amendment. Earlier, this was this particular amount that is to be treated as the amount in common credit was after reducing 5%. That 5% reduction is not applicable now. You can give full and then do only the reversal for 48 months. If I give reduced 5%, then I was giving it for another 5 years, not required, only for the left out period that I'll give. Next, second case. Same type of example, 1st January 2019, 1st January 2020, I purchased machine Q. At the time of purchase, 1 year back, okay. Okay, so it's not 24, it's 23, okay. 31st December 2023. 5 years. Okay, 1st January 2019, 31st Jan 2019, another 4 years, which will be 31st December 2023 or 1st January 2024. Okay, so that makes it 60 months. So there's a period of 48 months left. So what did I do? What did I do at that time? Missionary Q, when I purchased, it was used exclusively for exam date. What would have been my treatment? Fully you're using for exam date. So electronic credit ledger would have got 0. Common credit would have been 0. Nothing, no credit for you. But on 1st January, you changed this machine, now started using for both taxable and exam date. I did not give you any credit at all. So is it fair? I said, no, it's not fair. So first thing I will give you in electronic credit ledger, GST paid was 60,000, same amount. Now I'm going to give you full 60,000 in my electronic credit ledger. How much will be treated as common credit? Again 60,000. How much will be my monthly credit? Which will be 60,000 divided by 60, which is 1000. Now this 1000 I will have to do E divided by F for the next 48 months and reverse it. Earlier, this amount credited to electronic credit ledger and common credit was after reducing 5%. Now there is a problem for you. You're saying that if that's the case, then you're getting credit even for this 12 months. This 12 months period, you're using it exclusively for exempted. So you should not be eligible for any credit. They said no problem. For this particular period, 60,000 into 5% per quarter into 4 quarters, that is 20%, 12,000 rupees has to be, apart from this has to be added to output tax liability. So what is the change that has happened here? The change is very nominal. The nominal change is that earlier we used to do this netting off. We used to give 12,000 will reduce first. Okay, so that is 20%. Then 48,000 will give it in electronic credit ledger. That 48,000 you divide it for the next. No, that's not the case now. They're saying that no, that is not how we are going to do it. We will give full credit of electronic credit ledger 60,000. We will treat entire 60,000 as my common credit. Then divide it for next 48 months only, not another 60 months, 48 months only. Then out of that amount, TM, I am going to do the E divided by F for the next 48 months. But for the first 12 months, what I'm going to do is that in the month of January 2020 itself, I will reverse and add another 12,000 to output tax liability. So in net, it is the same. Only thing, now they are saying that TM has to be a higher amount. TM has to be treated by taking the entire amount credited to electronic credit ledger as common credit. So whenever you are treating to be 60 months, it should start from the date of invoices 1st January 2019, not from the date of conversion. To facilitate that, they have made a slight change in this particular provision. This is the amendment that we have in that case. I hope this is clear for all of you. So this amount that is reversed, is called as TIE. Okay, we have name for this. And all this amount that I'm going to multiply with E divided by F, I'm going to call it as TE. Every month I'm going to reverse TE. And in the month of conversion, when I'm doing it from exclusively exempted to both, I have to reverse TIE, which is 5% for every quarter I have used exclusively for exempted. Now if you go and read the statutory update of ICA, you will understand it. Pakka. Okay, now let's look at the last portion. So if you are an intermediate student, I think you should stop this video here and then move to the last part of your discussion on exemption, which is part 6. wherein I'm discussing about procedures. Okay, now for file students, hang on, I would like to discuss one more additional amendment for you. Apportionment of ITC in case of business reorganization. Okay, so there's been clarification that is given in Rule 41, which says that how do you apportion ITC in case of demerger and similar cases. There are 3 points that you will have to be careful about. Apportionment of ITC based on the ratio of old asset to the new asset to be done state-wise at distinct person level, not all India level. Point number 2, transferor can decide how much of the components of GST, that is CGST, SGST, IGST, to be transferred to transferee with a condition that they cannot transfer more than what they have in each head of electronic credit ledger. The ratio will be applied on ITC balances on the date of filing ITC-02 based on the value of asset on appointed date of demerger. So just very small 3 points. So stop for a moment and read this, and then start playing it again so that you will have more clarity on whatever I am discussing. This can be applied on demerger or taking a new registration, all similar cases. The Tatas. Suppose this is some different Tatas. Okay, 100 crore is their total all India asset. Which is there in 2 states, Kerala and Tamil Nadu. 50 crores, 50 crores. Now they have 2 set of business. One is watch business, another one is eyewear business, glasses, spectacles. They decided they will sell off the watch business. Watch business is demerged. Now some other company, say Lenskart, decided to buy their business. Now, since Tata has invested in a lot of capital goods, their electronic credit ledger has credit balances 10 crores. They have 10 crore credit balance still there. Now, can Tata's give the entire 10 crores to Lenskart? No, because they are not buying their they're not buying their eyewear business, they're only buying their watch business. Lenskart also wants to expand into watch, so they're buying. Lenskart already has eyewear, so they're only buying watch business, they're not buying eyewear business. So the credit attributable to their watch business to the total asset value, the ratio of asset, that much only will be transferred to them. This 10 crore is distributed like this. 4 crore ITC, electronic credit ledger balance, is there in Kerala registration, and 6 crore balance is there in Tamil Nadu registration. Now, in this, watch business has an asset of 20 crores. Here, watch business has an asset of 30 crores. So, if you look at what is the total percentage of asset that has been transferred, out of total asset, transferred asset is 50 crores. 20 plus 30. So out of 100 crore asset, 50 crore asset has been transferred to Lenskart. Now the clarification here is, how do you give the credits to Lenskart? Now, can I give the credit 50% to Lenskart? Should I calculate it like this? The point is, first clarification, you should do this state-wise. What's the ratio of asset? 20 divided by 50, that is 40%. Here 30 divided by 50, that is 60%. So in Kerala registration, how much ITC transfer is possible? It is 40% of 4 crore, which is going to be 1.6 crores. Correct? Then here it is going to be out of 6 crores, 60% of 6 crores. Okay, which is which is going to be 3.6 crores. Are you understanding? Okay, so they're saying that it is not going to be computed on an all India level. Even though you're transferring 50% of your asset, your asset ratio is going to be 40% for Kerala and 60% for Tamil Nadu. This is the first case. Are you understanding this? Okay, this is the ITC that to be transferred. Now, this 4 crore will have a component. It says your creditors IGST, CGST, SGST. In IGST, in electronic credit ledger will be all of this credit. So in the IGST they have credit of say 2 crore, 1 crore, 1 crore. How much you're going to transfer? 1.6 crores. This is flexible. How much they can transfer? If they want, they can transfer 1 crore of SGST itself, then 0.6 of CGST and nothing of IGST. Or they can do 1.6 crores of IGST itself. Can I do 1.6 crores of CGST? That's not possible. They're saying that this is flexible. How they want to divide and then transfer is up to them. But the total should be 1.6 crores. Also, I cannot transfer more than what I have. That is not possible. Okay, so say in the case with here. Say for example, the 6 crore composition is 2 crore, 1 crore and then 2 crore, 2 crores and 2 crores. This is how the composition is. Now they have to transfer 3.6 crores. How they want to transfer, how much of IGST, how much of CGST, how much of SGST, that is flexible. They can transfer it in that. So they're saying, now come back. Apportionment of ITC should be based on the ratio of old asset to the new asset to be done state-wise. Okay, then transferor can decide how much of the components of GST, that is CGST, SGST, IGST to be transferred to the transferee with the condition that they cannot transfer more than what they have in each heads of electronic credit ledger. The ratio will be applied on the ITC balance on the date of filing ITC-02 based on the value of asset on the appointed date of demerger. So, what is the value of asset on the appointed date of demerger? The date of demerger, what is the percentage of asset they have in each state which is transferring? That ratio will take, and then we will see on the date of me filing ITC-02 how much credit balance is there in each of the heads. The total has to match. That's it. You can do the flexibility. I can transfer fully from CGST, fully from that I can do. I have to just mention that amount. This is the last amendment that we have. So make sure that you go through these amendments because this is very important. So I'll see you with the next session on procedures.